this morning the global cues are quite subdued. So most markets, both Asia as well as the European futures, indicating that the start for those markets could be in the red, and most of Asia as well is trading in the red. Today is an important day for Greece. We've talked about the Grexit several times. There's a new one now on the Greg. Today is the deadline for Greece to strike a deal with its European Union partners to get some aid. Remember, it needs 2.5 billion euros going ahead for just to stay in the game in terms of the economy. But Richard Yetsenga, the head of global market research at ANZ Research, joins us on the line from Sydney. Richard, what is your own expectation of what will happen, at today's meeting with the EU partners?
Look, there are obviously high elements of uncertainty, but I think a deal today is quite unlikely. There seems to be still quite a bit of distance between all the parties, and it's not even possible, in fact, really to identify where the main issue is. It seems a general problem, difference of opinion around the broad approach to this issue, I think, which is why I say, any sort of firm deal today seems very unlikely.
So what happens if that deal doesn't come, as you say, it's unlikely to? Will we see any Greek defaults from now to May 11th, when the next meeting is scheduled?
Look, I don't think so. I mean, obviously, I'll probably keep emphasising the word uncertainty, but I don't think so. I think we're actually talking about well into May, or even, possibly June, if some things go in Greece's favour in terms of their creditors being a bit lenient for when we really face deadlines which seem immovable. So for those of us who think this is going to affect financial markets, we could be waiting a little while yet, unfortunately.
Okay. Those are the financial markets in and around Europe. But what about the rest of the world, Richard? Do you think this Greek issue has the ability to snowball into a bigger issue for financial markets globally, or should we not be too worried?
Look, I think we should always be worried about any sort of default. I mean, obviously, if Greece had defaulted in the height of the European crisis in 2011, 2012, it would have been a very significant issue. The experience we've had with major defaults in the last decade have been particularly uncomfortable. So there are obviously a range of reasons for thinking that, if Greece unfortunately does end up defaulting this time, that it will be less serious than we might have seen a couple of years ago, but certainly not something to ignore. And at the very least, you think it would be an issue for European asset prices. I mean, it's confirmation, for instance, that the euro is really just a group of fixed exchange rates rather than genuinely a common currency. And I think that would be problematic for Europe and the message they're trying to send.
What you're trying to drive at is, in your own treasury, for instance, are you moving around assets in some fashion just to hedge yourself against, the happenings in Europe?
Look, the favourable aspect of the Greek situation is, the financial market community globally has had a couple of years to get used to this situation. Yes. So if you look at holdings of Greek debt, for instance, almost all of the Greek debt is held by either Greece's official European partners or the IMF. So, which is why I think the direct effects of a Greek default are likely to be relatively modest. It's the flow-on effect potentially to European assets more broadly, which is where there are some questions. And even there, the fact we're talking about questions rather than having a generalised expectation of contagion, I think tells you how less extreme the situation is now compared to a couple of years ago.
All right, we'll leave it at that, Richard. Thank you for your perspective. Most of the debt is held by institutions.